You know that feeling you get when you check your 401k balance and it's finally hit six figures? Maybe it's $200,000, $500,000, or even $1 million. You feel good, right? Proud, like you've done everything right. You've been maxing out your contributions, getting that company match, doing exactly what every financial advisor told you to do since day one. Here's the thing though, that number you're looking at, it's a lie. Not in the way you think. The money's real, it's sitting there. But that balance, that's not actually your money. A huge chunk of it, maybe 30%, maybe 40%, in some cases over 50%, belongs to the IRS. You just don't know it yet. And the absolute worst part? The way the system is designed, the bigger that balance gets, the more painful the tax bomb becomes. You've essentially been building a financial time bomb for decades, and it's set to explode right when you need that money most, in retirement. Today, I'm going to show you exactly how this works, why almost nobody talks about it, and what you can actually do about it before it's too late. My name is Alex, and I spend way too much time thinking about investments and taxes. If you're someone who's 25 to 60, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Look, I need to start by saying something that might be controversial. The 401k is not the miracle retirement vehicle that everyone makes it out to be. Now, before you click away, I'm not saying it's bad. I'm not saying you shouldn't use it. What I'm saying is that there's a massive hidden cost that almost nobody calculates until it's way too late. Let's use a real example. Say you're 35 years old. You've got $100,000 in your 401k right now. You're contributing $20,000 a year, maxing it out. Your employer matches 5%, so that's another few $1,000s. You're doing great, right? You run the compound interest calculator, assume a reasonable 7% annual return, and by age 65, you're looking at roughly $2.3 million. Here's what most people don't realize. That $2.3 million is not what you're actually going to have to spend. Every single dollar you pull out of that 401k in retirement is taxed as ordinary income, not capital gains, not some special retirement rate, ordinary income, the same rate you pay on your salary right now. So, let's do the real math. Say you retire at 65 and you want to withdraw $100,000 a year to live on. Sounds reasonable with a $2.3 million balance, right? That's only about 4.3% withdrawal rate, well within the safe zone. But here's the problem. If you're married filing jointly and you pull out $100,000, you're solidly in the 22% federal tax bracket as of 2024. That's $22,000 gone immediately. And depending on your state, if you live in California, New York, New Jersey, add another 5 to 10%. Let's say 7% to be conservative. That's another $7,000. So your $100,000 withdrawal just became $71,000 in actual spending power. You effectively have a $1.6 million portfolio, not $2.3 million. And this is where it gets really interesting, because it actually gets worse than this. Now you might be thinking, okay, Alex, I get it. Taxes exist. I knew I'd have to pay taxes eventually. That's the deal, right? I got the tax deduction going in, I pay taxes coming out. Here's what they don't tell you. You don't get to decide when and how much you withdraw. The IRS does. When you turn 73, used to be 70 and a half, they recently changed it to 73, you were legally required to start taking money out of your 401k, whether you need it or not. These are called required minimum distributions, or RMDs. The formula is simple. They take your total 401k balance and divide it by your life expectancy factor. At age 73, that factor is roughly 26.5. So if you've got that $2.3 million we talked about, your first RMD is about $86,000. You have to withdraw it. You have to pay taxes on it. But Alex, $86,000 isn't that much if I've got $2.3 million, right? Wrong, because here's the backdoor tax that destroys people. Those RMDs can push you into higher tax brackets, tax your Social Security benefits that would have been tax-free, and, this is the big one, increase your Medicare premiums through something called IRMA. Let me break this down because this is genuinely insane. Medicare Part B, your standard medical insurance, costs about $174 a month for most people in 2024. But if your income exceeds certain thresholds, you pay more, a lot more. For a married couple, if your modified adjusted gross income is over $206,000, your Medicare premium jumps to $244 per month per person. Over $258,000, it's $349. Over $322,000, now you're paying $454 per person per month. Here's the trap. Your RMD counts as income. So let's say you've got $30,000 in Social Security, $20,000 in investment income, and your RMD forces you to take out $150,000. Congratulations, you just triggered IRMA surcharges. You're now paying an extra $3,000 to $6,000 per year in Medicare premiums that you wouldn't have paid if you'd structured things differently. And it gets even worse if you're single, because the income thresholds are much lower, starting at just $103,000. This is what I call the tax torpedo. Your RMD pushes you into a higher tax bracket, taxes your Social Security benefits that would have been tax-free, and increases your Medicare costs. You can easily end up with an effective marginal tax rate of 40 to 50% on that withdrawal. Let me put this in perspective. You saved that money in your 30s and 40s to get a 22% tax deduction. Now you're paying 40 to 50% to get it back out. You literally lost money on the tax arbitrage. Let me give you a real example I saw recently, not a client, but a case study that made the rounds in the financial planning community. Couple in their early 70s, they'd done everything right, saved diligently, maxed out their 401ks for 30 years, retired with about $3.2 million between both of their accounts. They also had paid off their house, had some taxable investments, and were collecting Social Security. Their first year of RMDs, they were required to withdraw about $120,000, add in $40,000 of Social Security and $15,000 from a small pension, and they had $175,000 of taxable income. They didn't even need all that money. They were living on $80,000 a year very comfortably, but the IRS doesn't care. The RMD is mandatory. So here's what happened. They paid about $28,000 in federal taxes, $9,000 in state taxes, and got hit with $4,800 in IRMA surcharges for Medicare. That's almost $42,000 in taxes and fees on money they didn't even want to take out. And the absolute kicker, 85% of their Social Security benefits became taxable because their income was too high. They paid taxes on Social Security benefits that would have been completely tax-free if they had had $30,000 less in RMD income. This couple essentially worked their entire lives, saved aggressively, and the reward was a massive tax bill in retirement that they can't avoid. Now look, I'm not telling you this to depress you. I'm telling you this because there are strategies to avoid this trap, but you have to start thinking about them now, not when you're 72 and it's too late. Here's what most people don't realize about the 401k. It was never designed to be your primary retirement vehicle. The 401k was created in 1978 as a small addition to the tax code, Section 401k, hence the name. It was meant to be a supplemental savings plan. The idea was you'd still have a pension, you'd still have Social Security, and the 401k would be a little extra on the side. But then companies realized, wait a minute, we can just get rid of pensions entirely, tell everyone to save in a 401k, and we're off the hook for retirement liability. And that's exactly what happened. So now we've got millions of people with their entire retirement savings in these tax-deferred accounts, and nobody stopped to think about what happens when an entire generation tries to pull money out at the same time. The psychological trap is this: we love immediate gratification. When you contribute to a 401k, you get that tax deduction right now. You see your tax refund, you feel smart, you feel like you won. Paying the taxes? That's future you's problem. And humans are really, really bad at caring about future you. But here's the thing. Future you is definitely going to care. Future you is going to be sitting there at age 73, forced to take out 6 figures from your 401k, paying massive taxes, and thinking, why didn't past me do something about this? So what's the actual solution here? The strategy that wealthy people use, and almost nobody talks about, is called a Roth conversion ladder. Here's how it works. You strategically convert portions of your traditional 401k or IRA into a Roth IRA over time, ideally during years when your income is lower. Now, when you do a Roth conversion, you have to pay taxes on the amount you convert. That sounds bad, right? Why would you voluntarily pay taxes? Here's why. You're paying taxes now at a rate you can control, instead of paying taxes later at a rate the IRS forces on you. Let me give you a concrete example. Say you're 50 years old, you just got laid off, and you're taking a year off before your next job. Your income this year is going to be basically zero. This is the perfect time to convert, say, $80,000 from your traditional IRA to a Roth. As a married couple filing jointly, the first $29,200 is covered by the standard deduction, zero taxes. The next $23,200 is taxed at 10%. The next $67,050 is taxed at 12%. You can convert a huge amount and pay an effective tax rate of maybe 8% to 10%. Compare that to the 22%, 24%, or higher rates you'd pay in retirement when RMDs kick in. And here's the beautiful part. Once money is in a Roth IRA, it grows tax-free forever. You never pay taxes on the gains, you can withdraw it tax-free in retirement, and, this is huge, Roth IRAs have no required minimum distributions during your lifetime. That $80,000 you converted, let's say it grows to $250,000 by the time you're 73. In a traditional IRA, you'd be forced to start withdrawing it and paying taxes. In a Roth, you can leave it there, let it grow, and pass it on to your heirs completely tax-free. Now you might be thinking, Alex, this sounds great in theory, but I can't afford to pay taxes on a conversion right now. I don't have the cash. Look, I get it, and this is why most people never do this. But here's the thing. If you can't afford to pay taxes on a $50,000 conversion now, how are you going to afford to pay taxes on $100,000 RMDs in retirement when you're on a fixed income? The math doesn't change just because you're older. The tax bill is coming either way. The question is, do you want to pay it on your terms or the IRS's terms? And here's a strategy most people don't think about. You can pay the taxes on a Roth conversion from your taxable brokerage account, not from the IRA itself. This keeps the full converted amount working for you in the Roth. Another objection I hear, but what if tax rates are lower in the future? Okay, let's be real here. We have a $34 trillion national debt that's growing by trillions every year. Social Security and Medicare are underfunded. Do you really think taxes are going down? Maybe for the ultra-wealthy, sure. But for regular people pulling 6 figures from their retirement accounts? I wouldn't bet on it. In fact, current tax rates are historically low. The top marginal rate in the 1950s was over 90%. In the 1980s, it was 50%. Right now, the top rate is 37%, and the current tax brackets are set to expire in 2025 unless Congress extends them. Rates are probably going up, not down. So here's the actual playbook. Step 1. Calculate your current marginal tax rate. If you're in the 22% bracket, that's your baseline. Step 2. Identify low-income years. This could be early retirement before Social Security kicks in, a year you take off work, a year with big deductions like medical expenses, or even just a year where you have more control over your income. Step 3. Convert up to the top of your current bracket, or even a little higher. If you're normally in the 22% bracket, converting enough to fill up that bracket makes sense. Going into the 24% bracket might even make sense if you know RMDs will push you into 32% later. Step 4. Pay the taxes from outside the IRA. This is critical. If you convert $50,000 and pay $12,000 in taxes from your checking account, you've effectively moved $50,000 into tax-free growth. If you withhold the taxes from the conversion itself, you only move $38,000. Step 5. Repeat every year. This isn't a one-time thing. You want to chip away at that traditional IRA balance over 10, 15, or 20 years. Let's run the numbers on a real scenario. Say you're 55, you have $800,000 in a traditional 401k, and you're planning to retire at 62. That's 7 years of conversion opportunity before RMDs start. If you convert $80,000 a year for 7 years, that's $560,000 moved to Roth. You pay taxes on it now, let's say an average of 18% effective rate, or about $100,000 total over 7 years. But here's what you avoided. At age 73, your RMD on $800,000 would be about $30,000 in the first year. On the remaining $240,000 after conversions, your RMD is only about $9,000. You've reduced your RMD by 70%, which means you stay in a lower tax bracket, avoid IRMA surcharges, and keep more of your Social Security tax-free. Over a 20-year retirement, that could easily save you $200,000 or more in taxes and fees. Now, if you're a high earner, we're talking $150,000 plus household income, there's an even more advanced strategy called the Mega Backdoor Roth. Here's how it works. The 401k contribution limit for 2024 is $23,000 if you're under 50, but the total contribution limit, including employer match and after-tax contributions, is $69,000. Some 401k plans allow you to make after-tax contributions beyond the normal limit and then immediately convert those after-tax contributions to Roth. You're essentially supercharging your Roth contributions way beyond the normal $7,000 Roth IRA limit. Not all plans offer this, so you need to check with your HR department. But if yours does, this is an absolute game changer for high earners who are already maxing out their 401k and Roth IRA. You could be putting an extra $30,000 to $40,000 per year into Roth accounts, building a massive tax-free nest egg. Here's something else most people don't think about. What happens to your 401k when you die? If you leave a traditional IRA to your kids, they have to withdraw the entire balance within 10 years under the new Secure Act rules, and they pay taxes on every dollar at their income tax rate. So if your kid is in their peak earning years, age 40 to 55, making good money, they're going to get slammed with huge tax bills on top of their regular income. They could easily lose 35 to 40% of the inheritance to taxes. But if you leave them a Roth IRA, tax-free, every penny. They still have to withdraw it within 10 years, but there's no tax hit. This is generational wealth planning. You're not just optimizing for your retirement, you're setting up your kids and grandkids to actually keep the money you worked your whole life to save. All right, so here's what you need to do right now, and I mean this week, not someday. Action 1. Pull up your last tax return and figure out your marginal tax rate. This is your baseline. If you're in the 22% bracket, that's what you're comparing against. Action 2. Log into your 401k or IRA and check your balance. Run a quick RMD calculator. Just Google RMD calculator and see what your required distributions would look like at age 73. Be shocked. Get angry. Let that motivate you. Action 3. Talk to a CPA or financial advisor about Roth conversions. Not all advisors understand this strategy well, so ask specifically, do you regularly help clients with multi-year Roth conversion strategies? If they look confused, find someone else. Action 4. If you're between jobs, retired early, or having a low-income year, do a conversion this year. Don't wait. Every year you delay is a year of potential tax-free growth you're missing. Action 5. Check if your employer's 401k allows after-tax contributions and in-plan Roth conversions. If it does, talk to HR about setting up a mega backdoor Roth. Look, here's the bottom line. The 401k is a tool. It's not inherently good or bad. But like any tool, if you use it wrong, you can hurt yourself. The traditional advice, max out your 401k, defer all the taxes, worry about it later, was designed for a different era when people had pensions and didn't live as long in retirement. It doesn't work anymore. The wealthy figured this out years ago. That's why they have massive Roth accounts and relatively small traditional IRA balances. They paid the taxes early when they could control it. You can do the same thing, but you have to start now while you still have time and flexibility. If this video helped you understand the hidden tax trap in your 401k, do me a favor and hit that like button. Share it with someone who's been religiously maxing out their 401k without thinking about the tax consequences. And if you want more content like this, deep dives into the strategies that wealthy people use but nobody talks about, subscribe to the channel. I post new videos every week breaking down the stuff your financial advisor probably isn't telling you. Thanks for watching, and I'll see you in the next one.